Good afternoon, everyone, and welcome back to Choices Life Coaching. And in this session, we will discuss the appropriate use of credit. And you're like, Jennifer, why is she saying this? Because I think this is something that every new coach and entrepreneur, or even just someone, whether you're in business or not in business, but I think just this is information that could benefit anyone and everyone. And I say that to say this, that the appropriate use of credit is important because the misuse of credit is one of the main causes for what? Financial distress. And right now, we're in transition. We are in the midst of a what? Pandemic. And with that, right now, people are looking for jobs or they're financially strapped, they're financially challenged. And I think that this segment it's your money, and I think you should understand how to manage it. And with this appropriate use of credit, and this means that the misuse of credit is one of the main causes of financial distress, and running up debt beyond what you can reasonably afford will always, and I say almost always, have a snowball effect. And that is, it can lead you down a path of even more debt. And knowing when not to use credit can be one of the biggest determining factors in the outcome of your financial planning. And in this segment, we'll discuss when it is appropriate to use credit and when it isn't. What are some of the alternatives to using credit? And what are some of the warning signs that you may be either overextending your credit? Now, I say that to say this because this is something that I've actually lived, believe it or not. So I can listen, so I can talk about it, right? I can definitely talk about it. And I say that because it's something that I think a lot of people in the country right now needs to understand what it is when it comes to handling their finances. And with that, we can start with checking your credit report and the credit ratings. And I see that, and I say that to say this, and this is create a budget. Okay. My brothers used to tell me that all the time, especially Rodney. Rodney be like, what's your budget, Jennifer? You understand? Did you create a budget? And I remember many, I think this was like back in the early, in the like 2006, 2007. And he was like, okay, then you need to understand your finances, and you know how to make a budget and a plan for yourself? And I was like, no, I didn't really to understand too much about it, but I had to learn. So now I learned. And that is when it comes to checking your credit ratings, okay? Anyone that has ever applied for credit of any kind has a file known as a credit report. Hi, Montel. Thanks for joining. Hi, Denise. Thanks for joining. Hi, Davina. Thanks for joining. And if we all have 3 credit reports. And these credit reports are maintained by what? 3 separate credit reporting agencies. And that could be Equifax, Experian, and TransUnion. And I can honestly say that, and yes, Curtis, thank you too, because you really helped me when I first started. And I just want to say thank you, thank you, thank you with that, because this is something that most people don't pay attention to. Because when it comes to knowing your credit score, most of us really don't know what our credit score is. And for the most part, there are 3 different versions of the same report. But since some creditors will only report your activity to 1 or 2 of these agencies, there can be some information on either one of the credit report. And that is not, that it may be on Experian, but not on Equifax, and some information be on Equifax and not on TransUnion. So for the most part, is the purpose of the credit report is to give potential creditors a way of viewing your history as credit usage. Now, this helps them to determine whether or not to extend their credit and at what interest rate to charge you. Now, since your credit report is a major determining factor. Hi, Kelly. Hi, Renee. Hi, Vanessa. Thanks for joining. Right? Since the credit report is a major way of determining that factor in how much credit how much credit is going to cost you. And it's important that you take the time to regularly review your credit report and ensure that all the information is accurate. Now, why do you say that? Because I knew that, I think one time I had gotten my credit report, and this was like way, way, way back. And there was stuff on my credit report that shouldn't have been there. Why? Because I had paid it off and it still showed up on my credit report anyway. And what did I have to do? I had to contact them to make sure that it was paid in full. And then I had to contact them to make sure that it didn't show up on my credit report. Now, these are things that we all need to, you know, pay attention to, and that is when to use credit. So far, we have to decide not just when to use credit, but let's get into it. Let's get into not just only when to use credit. Let me open this up. The cost of credit. And a lot of people don't realize that credit will cost you, right? One aspect of credit that many people fail to either truly examine and understand is the cost of credit. Unless you're borrowing money from a friend or from a family member, chances are that whomever is extending you credit or extending credit to you is doing so with the expectation of receiving even more money in return. They extend credit to new college students as freshmen going into college. I'm like, how do they extend people going in, like, like a freshman just entering college? Believe it or not, along with their books and education, they get a credit card. And with that credit card, unless they're working to pay for that credit card, Most people, when they graduate college, believe it or not, are in debt, not just from the school fees, but also in because they have credit card debt. Now, unless you're borrowing money from a family member or a friend, you understand, chances are that the credit company, whoever is extending you credit, or extending credit to you with the expectation of receiving even more money in return. And that more money is the interest that the credit card companies add to those credit cards. Now, credit is a big business, and creditors charge interest and fees in order to what? Make a profit, profit, on the money being loaned to you. Now, this interest can make certain purchases extremely expensive, and that's why it is critical for you and your financial well being that you understand what the true cost is whenever you use credit. Now, let's look at some examples of credit and how much certain purchases really cost. Now, when it comes to credit cards, let's say that you have a credit card with an interest rate of 19%, and you decide to purchase a $2,000, say, big screen television, or just any item, say that's worth $2,000. So if you paid $100 per month on that credit card, it would take you at least 25 months to pay off the debt. Now, and believe it or not, the interest rate is $424 in interest. So within 25 months, for a $2,000 credit, you understand, the credit card company has just earned $424 in interest. So now your $2,000 purchase will actually cost what? Will actually cost you what? $2,424. What if you doubled that and made a $4,000 purchase? And that's even double the monthly payment, say, to $200 per month. Now, under these circumstances, it would still take you 25 months to pay off your purchases. But now you're paying what? $848 in interest, because don't forget, for the $2,000 interest, for the $2,000 purchase, you were paying $424. With the $4,000 purchase, that interest rate has now doubled, and you are paying $848. Now, the minimum monthly payment, believe it or not, the figures above actually represent some of the best circumstances for paying down credit, and I say that is credit card debt. It assumes that you'll be paying either more than the minimum monthly payment each month, which likely means that you've done some budgeting and you've put a plan in place to eliminate this debt. Now, unfortunately, many people don't take this approach. When it comes to credit cards and you only pay what is asked of them, and that is what? The minimum payment. This is especially true when people start getting into, say, financial trouble, and they have more bills and expenses than they can actually handle. What if you made those purchases and only made the minimum monthly payment? For credit cards, this is usually 3% of the total balance. Well, the $2,000 purchase would take what? 145 months. just over 12 years to pay off the cost of what? Say $1,893.01 in interest. Like, you understand? So now your $2,000 purchase has turned into a debt that will probably last longer than the item itself. And then it has cost you what? It has cost you what? $3,898.01. What about the $4,000 purchase? And that's even worse. Now we're talking about 194 months. That's just over 16 years. And the $4,000 that would be what? 16 years, $4,128.14 in interest. At this point, you've paid more in interest than you did for that item, or for the actual item. And we're still working with what? The big screen TV. At this point, you've paid more in interest than you did at the actual time when you made that purchase. Now, say your gold purchases has cost you what? A grand total of $8,128.14. Now, with that, as you can see, when you add up the numbers, believe it or not, it gets really tricky, because people are wondering, my gosh, like, this is something that I think people not only in the business community should understand, but in the Black and brown communities, and in I guess this is something that they should teach in school. I really think that. And I think that this is something that should be taught so that our young people can understand understand finances, and understand money, understand credit. And it's all in gaining information. And with that, with the minimum monthly payment, that figures above actually represent some of the best circumstances for paying down credit card debt. And it assumes that you'll be either paying more than the minimum monthly payment each month, which likely means that you've done the budgeting and that you have put a plan in place to eliminate this debt. Unfortunately, many people don't take this approach, and when it comes to credit cards, and only pay what is asked of them, and that is the minimum payment. Now, let's take a look at car loans. As you can see, credit card debt can be expensive, and the more you take on, the more it'll cost you in the long run. Even credit used at the same interest rate can cost you significantly more at the significantly more as the balance increases. Now, car loans. Car loans typically have significantly lower interest rates than credit cards and have a fixed repayment calendar. And so that will say, like a schedule, so that will something like that, what will something like that cost you? Right now, if your car payment is due on the 15th of every month, right? Car loans typically have significantly lower interest rates than credit cards and have a fixed payment calendar schedule. And this is something that we can take a look at just just follow me here, right? Let's say that you're buying a vehicle for $20,000. For the purposes of this example, we won't even get into things like sales taxes and other fees. We'll just say that the car loan is what, 20,000 even, right? Now, yet you get the loan at 7.5%, and you'll be repaying it, paying for that vehicle over a 5-month period or a 6-month period. If you just stick to your regularly monthly payment, this loan will cost you at least what, 4,000 and $4,045.54 in interest. So now your $20,000 car payment really is $24,045.54. Now, when it comes to extended loans, in order to make monthly payments lower, many car dealerships have been offering loans that extend beyond the 5-year time frame. On the surface, this appears to many consumers as though they're getting a better deal because the monthly payments are lower. But what is it really costing you? And I say that to say, all right, they've extended the payment. Let's say you purchase the same $20,000 vehicle at 7.5%, but decide to opt in for a 6-year plan. That plan now is going to cost you $4,897.76 in interest. And that extra year, because they extended it an extra year, you're actually paying what, $852.22 more. Now, I've always, since 2006, I've always leased my vehicle. So like every 3 years, I get a new car. Just before the pandemic last year, I would keep the car for 3 years. And then I went back to the dealer, and believe it or not, they extended it. Instead of the 3-year warranty, they extended it to a 4-year warrant, to a 4-year plan. So instead of me paying that 3-year payment, paying off my vehicle within 3 years, turn it in, get a new car, or pay off that vehicle, then get another vehicle, they extended it to 4 years. And what ended up happening? That means I'm paying extra money for that 4th year in interest, just in interest payments alone. So always remember that extended repayment periods might help you reduce the monthly payment obligation, but it will always increase the actual cost of the loan. Now, when it comes to home loans, say a mortgage is likely to be the largest loan item that you're going to get, right? So you're going to get like a new home, you're purchasing a new home. And this is going to be your forever home or an investment home. Now, as the mortgage is likely to be the largest loan that you'll ever take out in your life, it's also likely to be the most expensive. Even with a fairly low interest rate, the long repayment schedule or the calendar that they give you, typically over a 30-year period, and large amounts of money being borrowed results in significant interest, and that is also being paid. Yes, Virginia, believe it or not, the interest rate sometimes is not always fixed exactly. Now, so how much does a house actually cost you? So let's say you're purchasing a small home for $150,000 and you get a 30-year mortgage plan and at a 6.25% interest rate. After 30 years of making that payment, this home will have cost you $182,487.29. What? In interest payments. Okay, so bringing the total cost of the house to, instead of the house being $150,000, believe it or not, it has doubled. And now the house that you thought you purchased for $150,000, believe it or not, is double, because it is $332,487.29. So even with a 15-year loan plan, if you can afford the monthly payments for a 15-year mortgage, this can save you an unbelievable amount of money. Okay? And I had to learn to love and understand my finances. And because I love you all, I love you all, each and every single one of you. I would like for you to understand the finances and understand your money situation, whatever your money situation is. And that is that the same $150,000 house at 6.25% interest for 15 years would cost you $81,504.17 in interest. Why? Because instead of that 30-year loan, now you have cut it in half to 15 years. The best way to pay down debt, right, is to make larger payments or cut the payment plan. And if they give you 30 years, if you can pay off the house in 15 years, awesome. Now, consider this when looking to purchase a property. As opposed to looking for a home, you can either afford, with a 30-year mortgage, perhaps it might be wiser to look for a home that you can afford with a 15-year mortgage plan. These are just some things that you can take into consideration. And I can say that to say that understanding your money situation, is a good thing. And I think this is something that everyone should look into, because now, oh, come on, be nice. Where is this? God darn it. When to use credit. And I think this is something that is important, because when to use credit, common purchases, right? Now, let's examine a few situations on how credit might help, how credit can help you or financially, or how credit can, it's not so good for you, how credit can help or how credit can hurt. And you can understand the circumstances. After my divorce, when I first got divorced, my credit was shot, and I had to reestablish my credit. And it is something that I'm speaking from experiences. Hi, Denise. Thanks for joining. Yes. Yes, this is something, reestablishing your credit after a marriage has dissolved, or after a breakup. Believe it or not, especially when you have joint accounts. Yes. Now, many have heard the advice not to use credit cards for common purchases, but if you're responsible, there can actually be some advantages to doing so. Credit cards come with many buyer protections, and that you can simply, you simply can't just get by using cash or credit. For example, if you lose your wallet, you can pick up the phone, call the credit card company, and cancel your credit cards without any liability to yourself. But if you lose a wallet full of cash and that cash may be gone forever, also consider that many credit cards offer reward programs that can help you to get nice perks from money that you were going to spend anyway. So the key to using credit cards for common purchases is to always pay for the full balance every single month. Always pay for the balance every single month in full. And whenever you make a purchase on your credit card, be sure to deduct that from your budget. And I say budget because if you had already spent that cash, never use the credit card to make common purchases that are either outside of your normal budget. When it comes to reservations, many businesses today require that you provide a credit card in order to make a reservation for goods and services, hotels, rental cars, if you're traveling. Say two primary examples of businesses that usually require this. In addition, they might place a hold on any additional funds that you have on your card. Now, reserving a particular amount of money as insurance that they will definitely receive the payment. Now, keep in mind that while these businesses require the card for the reservation, your final payment usually does not have to be on that one credit card. So to avoid running up the balances on say your Visa or MasterCard, consider using cash to finalize the transaction. When you check out of say the hotel or return the rental car, online purchases. Right now, in the midst of the pandemic, online purchases is the end thing now with Amazon and DoorDash and delivery purchases. Because it's a pandemic, everybody hasn't received their vaccination as yet. Now that the country's opening up, more people are shopping, and the malls, yes, hanging out at the malls. They're doing a lot more in-person stuff because now that people are being vaccinated, but there is still a lot of online purchases. So there are thousands upon thousands of online retailers that are virtually all of them require the use of either a credit card or a debit card. Now, while both will get you the same result, the item that you purchased, many people feel more comfortable using a credit card online because the credit cards have increased the protection against fraudulent purchases and are not directly tied to the money in your bank account. So when using credit cards for online purchases, it's important to follow the same rules as if you were making a common purchase in the store. So don't purchase anything that is either outside of your normal budget, even with online purchases, that you want to be sure you're putting that money aside to pay for the credit card and to pay off that credit card entirely at the end of the month. Prepare for emergency situations. If you're following your budget, then you should have a savings account that you can draw upon in the event of an emergency. There may, however, come a time when the cost of the emergency exceeds the balance of your savings account. So in this instance, you may need to use your credit cards to make up the difference. Now, if you fall into a situation like this, and it's always best to use the credit card with the lowest interest rate. Immediately following the emergency, you will want to what? Update your budget and strategize paying off the credit card as soon as possible. Now, an important note is a situation like this highlights the importance of not running up your credit card debt, having your credit cards maxed out, and then not having the available funds. So make them which makes them unable to be used in the event of an emergency. So even when you do have enough money in your savings account to cover the expenses of any particular emergency, there might still be a situation that would require you to use credit cards. Now, whether you're withdrawing funds from a saving account definitely takes more work than just swiping a credit card. So it might be best to just use that card up front, but then pay for it and then to pay it all off at the end of the month with the funds from the savings account. Now, when it comes to major purchases, for the vast majority of consumers, a major purchase will require the use of some credit. And purchasing a new home or a vehicle outright is cost prohibitive it's cost prohibitive for the average American. So we need loans to obtain these items. Now, when making major purchases, be certain to shop around for the lowest rate and always, always, always take the shortest repayment plan that you can afford, okay? And on that note, thank you so much for joining me on this session of Understanding Your Money. And I say that because it is something that we need to take a good look at. And that goes for just normal, regular people. Everybody is not a business owner or a new entrepreneur, but this is something that I think every person should understand, is understanding your money and the finances. And when it comes to credit, when it comes to savings, when it comes to organizing getting your bills and everything in order. And on the next session, I will be discussing, our topic will be, and this seems to be a big one because I see it a lot online and I hear about it on the internet a lot, and that is identity theft. Believe it or not, it happens, okay? And thank you so much for your time, and thank you for listening and watching. Thank you, thank you, thank you, thank you for listening. And thank you to all my listeners and everyone that has joined. Thank you all very much. I hope that everyone is having a wonderful summer. I hope that everyone has got their vaccine, and let's stay connected. And I think my next topic will be understanding identity theft, okay? And on that note, thank you all for joining. See you at the next session. Have a wonderful evening, everyone, and have a great day.